Federal Reserve recognizing the need for an interest rate hike and soybeans plummeting in the Chicago Mercantile Exchange. Mike Zuzolo is going to comment about that and several other issues right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Stay tuned and don't forget to subscribe. So, Mike, as we speak, we are one day later, one day after the Federal Reserve meeting, and they said they are going to anticipate an interest rate hike, but many economists thought that well, that would happen a lot sooner. What's your opinion on that?
I've been more focused on the word transitory than anything else, Luis. I felt like that the Federal Reserve had maybe worked themselves a little bit into a corner by talking about the inflation and the inflationary pressures on prices being transitory, and that if they would back off of that in this month's update, then that would open the door for them to discuss more specifics at their big Jackson Hole meeting in Wyoming in early August. And I feel that way still after seeing the comments and looking at some of the press conference transcripts. They took the transitory mindset away from their talking points. And I think that was enough. That was enough for the inflation funds and the inflation bulls to run for the hills. I think these last 2 weeks, unfortunately, have been, as I'd feared, that the weather you have on one end of the spectrum, but then just as important on the other end are these policy decisions and these policy moves that can impact negatively the investor demand and the physical supply demand. And whether it's China limiting their commodity speculation, or just today, before we went on the air, there's fresh news breaking that China is now going to shift and change some of how their commodity indexes are priced, and they're going to be watched over very closely. That sounds okay, but you have to ask the question, why come in now? And it's probably because they don't want their inflation to be reading as high as it does at the producer level. And so it makes one in the analytical world think that maybe their data is not going to be as useful or as trustworthy, and reflect exactly what's going on in their economy, because it's going to have the finger of the government is going to have their finger on the scale, so to speak. I don't know that for sure, but it makes me wonder that. And so these policy issues have really just played out in the markets. I mean, the Fed policy meeting to me was the last shoe to drop. The soybeans and one of the crucial commodity index charts that I track fell below a key support line right before the Federal Reserve opened up with their press conference on Wednesday's close in the grains. And we saw the follow through on Thursday. And I think this is just the big footprint of the funds and the inflation bulls running for the hills. And you can see that by the fact that the bean oil was one of the leaders to the upside and helped the soybeans climb to where they got to. We went up about, 67 days. We rallied in the bean oil to an all-time record high. And within the last 10 days, from June 7th to June 17th, we've been able to erase 67% of that rally. That is the funds. That is a supply-driven market. And so we can now say that's what's been driving this train. The last thing we want to probably wonder about, though, is it all final and over with?
Yeah, so how does that is going to impact your marketing strategy as the soybeans are plummeting and more inflation is still coming?
Yeah, brokerage clients were recommended on Wednesday before the market closed and early in the session to get some hedges in place on beans. And we moved more aggressively into over 75% hedged in soybeans. But Louise, we're doing this very, very respective of the yield and the weather. I still believe at this stage that the national yield is going down, not up, in United States corn and beans. And I also believe, and I'm ready to, pretty much go on record as having the opinion that the spring wheat crop is irreversibly damaged. And we just don't know how bad it is, but it's bad. And this comes from not just the crop conditions in states like South Dakota being at 17% good to excellent with zero in the excellent category. So they have 17% of their crop in the good category, zero in the excellent category. Last year at this time, they were at 70%. Same with North Dakota, same with Montana. North Dakota's at 29% good to excellent. Last year at this time, they were at 78%. So I think the spring wheat crop is irreversibly damaged. I've got people that I've talked to, media people and agriculture people that would confirm that opinion because they've been out looking at the fields. So now is the question is the corn and beans just around the corner, a couple, 3 weeks away from me saying and suggesting the exact same thing and giving the exact same opinion. So the hedges I put in with soybeans were paper hedges, not cash related hedges, because if this weather doesn't turn around, not only could we expect the futures market to turn around, but I think also the cash basis levels in some of these key areas to really turn into maybe a historically tight or historically strong basis. So we really want to be careful about how we hedge. But I essentially hedged going into the end of the month with the acreage and stocks report in the forefront of my mind and the Federal Reserve in the forefront of my mind.
And the heat is affecting also your own state of Kansas. I read an article from the Kansas State University recommending producers to avoid double cropping because of these weather
Yes, and
issues.
next week I will be going to a regional cattle conference and doing a speaking engagement south of Kansas City, pretty much straight south of Kansas City and a little closer to Wichita, Kansas. And that's kind of the heart of cattle. And, you get into some real strong hard red wheat country in that area too. So I'll have a lot more to tell you about that in a couple weeks because it'll be a next Thursday that I go down there for a dinner meeting and conference. But I think what we're seeing in Kansas and the Western Corn Belt is a situation where the pasture, the forage, the hay, all these things are going to go down pretty rapidly. And I think this brings me to what we're going to look forward to on the drought monitor index. That came out Thursday. It really didn't matter at all to the trade because of these macro induced, policy induced issues and with the idea that the weather was going to shape up and come around between now and the end of the month. If that weather doesn't come around and shape up by the end of the month, though, this what we saw in the drought monitor maps this afternoon is only going to get worse. And I think the trade's really going to have to reflect on that and start once again thinking supply is falling faster than demand. Right now, because of the biofuel policy question here in the United States, the Chinese move, the Mexicans talking about the non-GMO, you and I discussed last week, I think. These are the things that are shifting that demand curve down. They're making demand go lower in the market's mindset. The WASDE report said the same thing in the soybeans by taking the old crop soybeans higher. Export sales are tapering off in soybeans, not so much in corn. So right now, the demand is falling faster than the supply in the trade's mind. That's why they're pushing prices back down and the inflation bulls are getting out. We may have to come back around and readdress all these issues again in 2 weeks if we don't get ample rains and we stay as hot as we are. We're going to break 100 degrees today. It's going to be one of the hottest days. We may break a record going all the way back to 1918. I found that kind of fascinating that was a pandemic year as well. But we are looking at temperatures of 102 to 104 degrees Fahrenheit, actual temperatures in this part of the country. Definitely the hottest I've seen it since I've lived here over the last 8 years. And so we are way far away from making our corn and bean yields 179 and a half and 51.9.
And then you mentioned the fuel. Ethanol inventories are going up by the data that I checked today as we speak. But on the other hand, there is more demand for both corn and sorghum by China, with a record demand for corn and the second largest imports of U.S. sorghum. So, how do you think that's going to play out with the
Yeah, I'm glad you brought
prices?
that up because this kind of a price break, corn closed limit down 40 cents on Thursday's trade, led by the soybean oil, which was down 9%. And it was down on extended limits, down 5.5 cents a pound on extended limits lower. Soybeans tried to match their extended limits by trying to get closer to that $1.50 limit down move. I think they only got down about $1.30. But I think the issue that I still see in the corn and the sorghum is a limited supply around the world and therefore less competition. And therefore, I'm not as eager to sell the corn at these price levels. I'd rather wait for another opportunity to the upside before I do that. This goes back to why I hedged the beans and left the corn open. I needed to do something in case the inflation bulls wanted to go ahead and run for the exits. And this is what typically happens when everybody runs for the exits at the same time. There's only a certain number of doors to get out of that exit and get out of that building. And that's where you get jammed up. And that's why we had these limit moves to the downside. Volume was very heavy on Thursday, and that's a negative feature. Some of the clients have been calling already and saying, where's the next downside? How much more can we go lower? Some of the commodity index charts that I keep track of would suggest another 3, maybe 3.5, 4% lower would be the next crucial support level. Corn closed limit down on a very key monthly support line. There's another one about 25, 30 cents below this level in the lead month corn. Wheat is closed right on a major support line on the monthly chart. And you notice that while we took out the May low in the soft red wheat, we have not taken out the May low in the corn. And yet, by the same token, the beans are at a 4 or 5 month low. They're down at levels not seen since December, January of last year. And those are going to be the levels of support for that, right around the $12.75 to $13 level.
Now, you think that the market has already fully priced in on the South American weather and the South American
No, I
crop?
don't. I think that the trade is still waiting for the USDA and CONAB to come down another 2, maybe 3 million tons on the corn expectation, and maybe raise the expectation on the soybeans by another 0.5 to 1 million tons. I think that's what they're looking at in the periphery, but they have a lot more to deal with right now than those numbers. They'll probably wait for the acreage report and the grain stocks report at the end of the month, and this again goes back to why hedge the beans other than the technicals and the macro? Well, because you've got the grain stocks report, and it looks like it's shaping up pretty negatively for the soybeans because of USDA's WASDE report, whereas WASDE took 150 million bushels off the old crop corn ending stock. So the grain stocks should look pretty friendly for the front end corn as we get July delivery the same day that we get the acreage and stocks report. But the acreage number is wide open right now. No one really knows what we planted because of the spring, because of how low USDA was on their estimates to begin with in March. So, I mean, that's another unknown that the trade, I think, feels comfortable between now and June 30th to essentially trade the momentum and trade the path of least resistance. And this is where it goes back to what's going to stop the downside. It's really going to be weather and rainfall totals and whether the US dollar takes out its 52-week moving average, which it's really close to doing at the end of this week now as we approach Friday's trade. We have not been above that 52-week moving average in the dollar since I believe it was back, May of last year, I believe. Yeah, May of last year is the last time we were above the 52-week moving average in the dollar index. But that Fed policy, as we've talked about, by taking away inflation by acknowledging inflation and taking away the transitory mindset, opens up the door for interest rate hikes, which then opens up the door for stronger bond yields and a stronger dollar. And that's what the trade is trading right now.
And by the way, the Brazilian Central Bank has increased interest rates for the third time in a row this week.
Yes, and that's been a real tailwind for us in the markets because the Brazilian real has been very, very strong against the US dollar up until the Federal Reserve meeting.
And so, what are your thoughts about the coming month ahead?
Well, I think I'm going to play it very, very short term. A week right now is like a month and a half or 2 months because of the price levels we're seeing. You and I talked about historical volatility not going away. I still feel like it's going to be around till August, September when we know whether we've replenished supplies or not. I think the other thing to really focus on is the profitability side of the equation. While we are off 20%, and here again, Luis, this is kind of a footprint of why I think the funds are involved in this market. more than the supply demand fundamentals, because we've got soft red wheat down 18 to 20%, corn down 18 to 20% from its highs, beans down about 21% from its highs as of Thursday's close. So when you have those percentages so close to one another in all three different grains, that tends to be the funds buying a section of everything, or an increment of everything. And this helps explain why the lumber's down 40% and the copper is down, I think, 25% roughly, or excuse me, 15% roughly. And the soybean oil now is down about 23%. But this is why I'm going to shrink my time horizon, because the funds are doing what they're doing. And we have out there still left to play out in the markets this whole ball of weather. I truly, I believe that we would not have gone down this hard if it would have stayed hot and dry, and Iowa would have looked dry another week. I don't disregard the weather completely, but I think the lion's share of this price break has to do with the macro and the policy, and very little with the actual weather. So if I'm right about that, then we should have that dialed in by the end of the month. And then we start all over again, essentially in the month of July.
I jumped at one question. What are you hearing about the crop in states like Iowa and Illinois?
They're dry, but they're not hurting badly. I just had a great conversation with the producer in Nebraska who had a lot of rains in the spring, but he hasn't had very much since then. And that seems to be a trend in some of these drier areas, except for North Dakota and South Dakota. And so he said, I've got great groundwater 2 to 3 feet below the corn roots, but the roots can't get down that deep yet. We can't get to the water at this stage of development. And that's why I think this June heat and this June dryness could really hurt the crop substantially, because it's not big enough to weather hot, dry weather in July. It's not going to have the root structure and the ability to tap that subsoil moisture nearly as well as if we would have had a nice June and then had a hot July. So that's something I don't think the trade understands at all, or is thinking about at all right now.
That was it for now. Thank you, Mike.
Thanks, Luis, and appreciate you having me. Have a great week, sir.